Sometimes it takes us a little bit to get to our main focus point because you guys call in and we love answering your questions. But we're going to talk a little bit about alternative investments now and the things you need to consider before you start investing. Now, the investment landscape in 2025 is shaped by a lot of trends, economic trends from recent years, including inflation, persistent inflation, higher interest rates, and the need for strategic portfolio diversification. And so while cash remains on the sidelines, many advisors believe that public equity markets are overvalued, and fixed income has been volatile as rates have been directionless at times. And what this does is it creates an environment where, well, investors are seeking other asset classes. And sometimes it's gold, sometimes it's alternative investments. And so alternative investments, especially in this environment, can play a role in the overall portfolio construction process. But what do you need to consider? Well, first you need to consider that there are expanding market opportunities, right? That's what you're trying to do here, getting uncorrelated assets together in one portfolio. Private markets provide access to a significantly larger pool of companies. How much more? 23 times more than public markets. This includes private equity, private credit, real estate infrastructure, farmland, and that offers diversification beyond what traditional asset classes offer. There are times at which equities and bonds, stocks and bonds, have similar correlations. Another thing you need to consider, though, is it might not be right for everybody. And that's because there's a long-term investment horizon. To fully capitalize on the benefits of alts, investors should plan to hold allocations for at least 5 years, maybe even longer. And that's because short-term fluctuations aren't really seen within private markets, right? They can provide entry opportunities when people are fire selling, but if you're trying to sell after short-term holding, you're missing out on the return generation that is requiring that patience. Another thing, and I would say is the most important thing, is liquidity planning. Alternatives often have far lower liquidity than public equities or bonds. And so because of that, it may not be right for everybody. Investors should assess their liquidity needs to determine an appropriate allocation to really illiquid or semi-liquid investments without disrupting their financial goals. So what are some things you can invest in? Well, private real estate could be beneficial. With new construction constrained by high interest rates, real estate supply remains pretty tight. And so this creates demand opportunities in sectors such as industrial properties, medical office spaces, and senior living facilities. Maybe you want to get into private credit. That's been all the rage recently. Middle market lending, particularly to private equity-backed companies, continues to present pretty attractive yield opportunities. Or maybe even farmland investments. Farmland serves as a strong diversifier with steady demand for agricultural products and long-term income growth driven by increased productivity and advancements in technology. Now, financial advisors who focus on these customized portfolio designs may start to more and more incorporate alternative investments into their strategies. The rise of personalized investing, particularly for younger generations, requires a more sophisticated approach that goes beyond the traditional 60-40 asset allocations of the past. Private market investments exhibit a greater dispersion of return compared to public assets, so that's something that is important to keep in mind. And because of this, it means that one must emphasize the importance of due diligence and expertise when selecting these opportunities. So as the economy shifts into a new paradigm of higher for longer interest rates, persistent inflation, integrating these alternatives could be essential for achieving stable, long-term, diversified returns.